Hi, I'm Bruce Whitey, host of Straight Talk Wealth Radio since 2007, and I've actually been serving retirees and pre-retirees with their retirement income and tax planning needs since 1997. Getting old, maybe. But what I feel so obliged to tell you about today is that for the last year or so, and for the first time in decades, we've been seeing rates on fully guaranteed cash equivalent accounts running at 5% to even 6%. Some special deals come and go with even up to 9% interest rates fully guaranteed. But if history and Washington teaches us anything, it's that those windows never stay open long. In fact, the last time the Fed pivoted toward cutting rates, the opportunity was gone in months. And with pressure mounting right now directly from the top, we're heading into another turning point fast. Now, if you'll just stick with me in this short webinar, I'm going to show you where to find these deals. I'll show you how to best utilize these deals into a portfolio blend, what's going to trigger making them go away, probably for more decades to come. And I'll tell you how to get a special report hot off the press recapping all this data. And because God knows I have so much other work going every day with my current clients for just a limited amount of time and for no charge and no obligation to work with us, I'll tell you how to have myself or one of our advisors help design a foundational model for your retirement portfolio so that you'll be able to take advantage of this high guaranteed rate window that's sure to start closing this year if it hasn't already started by the time you see this. Now listen, for retirees and pre-retirees, this isn't just about chasing yield. This is about locking in guaranteed income and protection in the most favorable rate environment we may see for the rest of this decade or more. Missing this moment could mean settling for half the income or taking twice the risk just to make up the difference. Yes, falling interest rates do tend to push the stock market higher. And yes, the markets could very well run hard when these interest rates fall. But that's the classic risk-on cycle. But if you're building a real portfolio, especially in or near retirement, chasing upside is only half the job. The other half is protecting the downside. And that's where most people make the mistake. They go all in, or they forget that even their so-called safe money is sitting idle. It's not being watched, or worse, it's underperforming. So when the market turns, they've got no buffer, no ballast, no calm in the storm. Not when their cash allocation is wallowing at 1% again. The window to build a strong foundation at 5 to 6% guaranteed rate is closing fast. And whether you're chasing returns in the market or simply trying to protect what you've earned, your base must be solid. When that base earns 5% instead of 2 or 1%, the entire portfolio performs better with less risk. So what's the problem? Most people aren't making terrible decisions. They're making no decision. They leave money sitting in cash, CDs, or treasuries, hoping rates will stay high forever, or they assume they'll get to it later. And that's where the damage happens. Because this isn't about whether you like annuities or not. It's about what happens when interest rates drop and the same guaranteed product offers you 2.5% instead of 5.5%. That's not just a different yield. That's a permanent cut in your future income. If you wait until after the Fed cuts, it's too late. Insurance companies will already have adjusted. The 5 to 6% offers will be gone, and they don't come back for decades. Your safety net becomes a missed opportunity. So before we're done today, I'm going to give you a copy of my private report, The Guaranteed Foundation Window, Why Now is the Moment to Lock in Rates That May Not Return in Your Lifetime. You'll also get access to a one-on-one strategy session where we'll analyze exactly how this could work in your real-world situation. Now, this is crucial. So many times I see clients come in that have a pocket full of maybe income annuities that they were sold from a seminar, but they don't have a clue how or when they're going to access their income provisions as part of any strategic retirement income plan. Or they've got a whole variety of different investments sort of thrown up on the wall to see if they stick or see what sticks. But again, no cohesive plan to make each of these investments complement each other. But that's exactly what we do in our one-on-one strategy session. So if you're thinking about locking in these historically high guaranteed rates, we can actually help you mold them into a strategic balance in your overall portfolio where they can make the most sense and play out the role that they're actually best suited for. But first, let me show you why this is not just another CD and why the multi-year guaranteed annuities, or MIGAs, are being called the best kept secret in retirement planning right now. Firstly, here's some important MIGA advantages. Real, true safety of principal. Now, sure, banks offer the FDIC. Honestly, the FDIC is nothing more than a poorly run, often insolvent, government-run insurance company that when it runs out of premium reserves from the banks to pay depositors, it has the luxury of putting a gun to the taxpayers' heads to make up the difference. The FDIC reserves went BK during the S&L crisis of the 80s and 90s, and it has utterly failed to actually rescue the banks in the great systemic collapses, such as the financial crisis of 2008, when Hank Paulson had to bypass the FDIC to demand $800 billion from the taxpayer money from Congress, or we won't have an economy on Monday morning. Conversely, insurance companies maintain trillions in reserves that have been almost impervious to economic collapses. From the 2008 Great Recession to even the Great Depression in the 1930s, insurance companies didn't loan policyholder reserves like banks loan depositor money. They hoard it into legal reserves and are regulated in 50 states and more in order to show the ability to pay claims on annual audits to the regulators. Also, CDs lock you out. You can't get your money out without penalties or loss of interest. MIGAs can actually include substantial penalty-free withdrawals. Money markets follow the Fed. They change overnight. MIGAs lock in the Fed's peak if you act now. CD interest is taxed yearly. MIGAs grow tax deferred and are never taxed until you actually withdraw those accumulated earnings. Look, here's a real example of how this could look. Let's take $250,000 over 5 years. If you act now, it can go into a MIGA and earn at least 5.5%. That's $327,608 when you tax defer it over 5 years. If you wait and you don't lock in these MIGA rates now, or even at current CD rates, you might get 3%, and it's taxed. So if you're at a 30% tax bracket, that totals $276,250. That's a difference of $51,358 against $250,000 that you deposited. I've been in this industry for over 25 years. Back in the 2000s, I was hosting a financial radio show in Los Angeles. Well, fast forward to today, and I can tell you this current interest rate window is unlike anything I've seen in 20 years in this business. This isn't about fear. It's about foresight. And I want to make sure that the people I work with, and even those I don't miss the window that could define the next 10 years of their retirement. Here's 5 essentials for smart retirement. 1, don't leave safe money just sitting in cash. 2, use tax deferral to grow more. 3, lock in a rate before the Fed moves. 4, match time horizons on this to the product terms. So you've got your money when you need it. Otherwise, you're getting the highest rate in the meantime. 5, treat the base as sacred and the market is optional. If you're already seeing the opportunity and you want to explore whether a MIGA or even a broader annuity strategy is a fit for you, you can click on the button now and schedule a free retirement rate lock session. There's zero pressure, just real answers, real numbers, and a look at what this could do for your portfolio before the window closes. Here's what you get when you book your retirement rate lock strategy call. You'll get the rate lock strategy call, that alone, which means that we're searching, we're looking for rates, we're seeing what we can lock in because people are going to see this at different times. That is a time cost for us, and it's typically a $297 charge to go in and just simply do a rate search. You'll get our free report, the Guaranteed Foundation Window. You'll get a custom income analysis, which will look at how to build your income through retirement. And you actually get a bonus retirement allocation blueprint. That's just kind of our retirement roadmap, looking at all of your allocations and all of your portfolio to figure out over time what is the most effective way to draw that income out and preserve the assets you have. And if you act right away, it's posted somewhere here, how fast you got to act. We'll include you in our priority rate notifications. That means that when rates change, we'll email you. And it might be too late by the time we email you, but at least you'll know they're on the move. But you can also get, and this is very, very important, right now for a limited time, because we can't always promise this with the companies, but pretty much we can get right now a 2-week rate hold window. That means if you decide you want to at least hold a rate on a product, we can put an application in, and if product rates change over the next 2 weeks, yours is held in solid and you'll keep the higher rate. To do this kind of planning privately, frankly, in a lot of places, it would cost you upwards of $2,000. But today, I'm offering the entire strategy session, tools, and resources 100% free. But for a limited time, we'll figure out what that is because I've got to get back to work with my other clients. Click the button, book your call. Let's lock in your best decade before the moment passes.